As an organization, it's very important to understand what the customers or stakeholders need and what you should be doing to ensure that these needs are achieved. Of course, you also need to translate those needs into key performance indicators, because then the problem becomes, how do you measure your success? Okay, what are KPIs? How do you set or develop key performance indicators? What metrics do you use to assess KPIs? And many questions. Now, there are two parts to this video, okay? So we have how to set KPIs and metrics we use to assess the KPIs, basically things like cost, quality, delivery, and safety. Key performance indicators refer to financial and non-financial metrics that are used to reflect the critical success factors of an organization or contract, which means there are three things there. There is key, there is performance, and then there is indicators. What are the key things, which are also the critical success factors? These are areas that are essential for a contract to be successful. Now, the question of performance, which relates to how the business is doing, in short, what state is the business in? That is something you need to know when you're talking about KPIs. And finally, indicators. Basically, how will the performance be measured? Before any business thinks of setting KPI, it must first of all find out what are the factors that are critical to its success. That is, critical success factors, or CSF. And that would mean figuring out the customers or the stakeholders' needs. Now, in case of a contract, critical success factors can be thought of as those areas that are essential for a contract to be successful. Okay, think of it this way, right? So an organization has a corporate strategy, right? And in that organization, we have a lot of departments. And these departments have things that are critical to their success. And from those things, KPIs emerge. Now let's talk about developing KPIs. So when it comes to developing KPIs, I mean, you can just go to Google and type how to develop KPIs, and then you see how that goes. But there are simpler ways to go about it. You see, with KPIs, okay, there are three things that you need to have in mind, or rather, there are three steps you have to take when you're developing your KPIs. You're talking about step 1, identify critical success factors. Step 2, identify measures of success or improvement for each critical success factor. And finally, develop and agree KPIs with key stakeholders. Now, obviously, you need to ensure that your KPIs are smarter. Yep, I know, smarter. Here's how that works. Specific, there is the need to be clear and concise measurement of precisely what is required. Measurable, which means they need to be quantified to gauge achievement. Achievable, meaning they need to be realistic given the available resources and context. Relevant, which means they need to provide useful data to gauge critical areas of performance. Time-bound, which means they need to be set with specific time frame for achievement and measurement. Now the all smarter part, okay, just means adding 2 letters, ER, to the SMART acronym, right? So in this case, we're talking about your KPIs need to be also ethical and recorded, in this case, documented. Now you can also say that your KPIs need to be evaluated and reviewed. So which are the other characteristics of KPIs? Now, in addition to being smarter, when you're talking about KPIs, okay, so the KPIs that you create should also be aligned to service delivery goals, provide context, because look, you just don't want to create KPIs saying, okay, this week we are supposed to have like X number of sales. Yeah, well, you know, that's just a number. You can throw it there. But then have you taken the entire, operation into account? How many salespeople do you have? What type of product are you even selling? Who are the customers that you're targeting? Or do you just think saying we need to increase our sales by 10% is a good enough? You need to take the context into account, okay? Next, create meaning at all organization levels. Number 4, be easy to understand. And number 5, lead to action. That is, something has to be, when you look at those KPIs, you need to look at them and then know, this is what I need to do as a result of these key performance indicators that we've identified. According to Wayne W. Ickerson's Performance Management Strategies, How to Create and Deploy Effective Metrics, effective KPIs have the following characteristics. That is, they are sparse, the fewer the better, drillable, users can drill into detail, simple, which means users understand the KPIs, actionable, users know how to effect outcomes. Owned, KPIs have an owner. Referenced, users can view origin and context. Correlated, KPIs drive desired outcomes. Balanced, which means the KPIs consist of both financial and non-financial metrics. Aligned, which means KPIs do not undermine each other. And finally, validated, so employees cannot circumvent the KPIs. Now, here's a quick checklist. When you're developing KPIs, here are a few things that you need to ensure that are in your KPIs. So here's a quick checklist. Number 1, can each KPI be assessed and compared objectively? Does each KPI have consistent result? Can each KPI be used to identify issues or trends? Number 2, are all KPIs clear and unambiguous? Are they understood by all parties? The third thing you look at, are the KPIs genuinely useful, or do they measure only what is easy to measure? Does each KPI assess only what is necessary to determine contract performance and supplier performance? Number 4, is the number of KPIs proportionate to the value, term, complexity, and risk of the contract? Are they too many or too few? Number 5, at what time or interval is data collected, and are these appropriate? Number 6, do the KPIs identify and encourage performance improvement over the whole life of the contract? Number 7, is there a periodic KPI review process to ensure that KPIs continue to be suitable and relevant? Number 8, how is data collected? Once collected, what is the process for understanding and interpreting the results? And finally, is it necessary to outsource collection and interpretation of performance data to an independent third party or technical expert? Yeah, when you're developing your KPIs, you look at some of those things and ask yourself all those questions and see if you are on the right track. So let's talk about something else. The purpose of KPIs. Let's talk about that. The purpose of KPI in relation to contract management will include measure improvement and performance. You see, when you talk about a contract, so you had a problem, you found a supplier or whoever is going to solve that problem, you went through the whole tendering process, you added the person on the contract, right? Now, just because you had a contract, a legally binding agreement, doesn't really mean that everything is going to just flow smoothly, because sometimes you may have a good relationship with the supplier, but the actual performance that you desire is not achieved. And that is the reason why you have to, number 1, ask yourself, how are you going to measure and improve the performance of the contract? So the purpose of the KPI in this situation is measure improvement and performance. Number 2, reward performance. Number 3, develop suppliers. Number 4, the fourth purpose, manage supplier improvement to ensure expectations and requirements are met. Because you see, in as much as there is something that you want out of that contract, there is also something that the suppliers want from that contract. And so you need to manage the expectations in that situation. Okay? Otherwise, you're not going to be in a good position in the end. Number 5, improve and strengthen relation with suppliers. Number 6, justify inclusion of each supplier in the supply base. Remember, you have the entire supply network. Why is that supplier there? When you're talking about upstream and downstream activities, if you look at the entire supply chain, so you have the people who provide you with these raw materials that you're going to use. And think of it this way. Let's say you have a framework agreement where you have all the suppliers and then you choose. Okay? And then somebody goes through your list and ask you, why is this company in our supplier list? So how do you justify that? Well, KPIs can help you to justify that. Okay. Next, identify suppliers who can no longer meet requirements and who need to be replaced. Those are some of the purposes, okay, of performance, of key performance indicators. In fact, in the book Measuring Business Performance, Neely sums up the purpose of KPIs in 4 ways. That is, check position. KPIs enable managers to see where an organization is in relation to its plan and its competitors. Number 2, communicate position. That is, KPIs are used to report on performance to internal and external stakeholders. Number 3, confirm priorities. Meaning what? Meaning KPIs are the crucial factors on which managers must focus. Number 4, compel progress. That is, performance against KPIs can be used to evaluate managers and staff. This ensures that every employee is committed to achieving them. So let's sum all that up by talking about advantages and disadvantages of KPIs. Let's start with the advantages for supplier performance. Number 1, motivate compliance and improvement. Number 2, manage supply risks. I mean, look, you have to understand something about a contract. Okay? The supplier is for the most part motivated to supply as many things as possible at the highest price possible. In fact, they want to supply those things at a cost that is low to them, and that means more profit to them. The buyer, on the other hand, is just motivated to buy those things at a cheaper price. So the point is, when you're contracting, there is always one party who's trying to take advantage of the other. And so the faster you know that, the better. At least that is if the contract was negotiated in a zero-sum way. You probably think, what if the contract was negotiated in a win-win way? Well, there is that, but deep down, there is always somebody who's winning and somebody who's losing. So with KPIs, you can easily, you can start to manage the risk associated with such contracts. Number 3, support contract management. Number 4, identify high-performing suppliers. And finally, give feedback for learning and continuous improvement. Now, limitation in this case will be, number 1, they focus on only the measured areas and not the whole performance. Number 2, KPIs can lead to cutting corners on quality or service to achieve targets. This is what you want, and then this is how you're going to get you what you want, and then you're going to ignore everything else. So that can happen. Number 3, KPIs can be misaligned with corporate objectives. Number 4, they can be time-consuming in terms of creating, monitoring, and to manage. Number 5, there is a risk that the wrong metrics can be selected. And finally, they can be out of date. That's something that can happen. You can be using KPIs that were used in a contract that was done like 3 years ago, because sometimes people are just lazy in the organization. They don't want to create new KPIs. So that is something that you also need to factor in, that you could be using KPIs that are actually outdated. The 4 notable KPIs that you should be aware of are cost, quality, delivery, and safety. Now let's look at all this. Now there is this supply chain council that is called the Supply Chain Council. And what they did is that they came up with the Supply Chain Operation Reference Model. If you're wondering what that is, it's a management tool used to address, improve, and communicate supply chain management decision within a company and with suppliers and customers of a company. The tool is really handy when you're measuring performance in 5 areas. There is plan, source, make, deliver, and return. With that tool, the Supply Chain Operation Reference Model, you can realize how well an organization does in the 5 areas and identify areas that need improvement. You see, the thing about supply chain metrics, if you are planning to create one, or if indeed you've created one, is that they have 3 crucial components. These are, number 1, they must translate financial objectives and targets into effective measures of operational performance. Meaning what? Meaning, if you have a plan, if your objective is like, I need to make $10,000 every month, then the question becomes, how does that $10,000 every month translates to activities that are going to be done on day-to-day basis? So you have to bring it down to that level. Number 2, they must translate operational performance into accurate predictions of future earnings, which means that if you do in fact succeed to make the $10,000 per month, then the question becomes, if you repeat these activities, does that mean that we will be able to make the $10,000 next month and 5 months from now? As in, these actions, can they predict the future? And finally, they must engineer behaviors across the supply chain that support the organization's overall business strategy. Thing is, measurement allows us to understand whether the performance is actually improving or is worsening. A supplier scorecard is something every organization should keep. A supplier scorecard will give reports that can be used to track a supplier's achievement of or progress towards targets or goals, which can include quantitative and qualitative data. So cost, quality, delivery, and safety are some of the things that are going to be part of contract performance management. Cost and quality are related, although they are not really the same when it comes to assessment metrics. Cost performance will be particularly important in construction-related projects in which cost-based pricing is used. But if you're talking about price, then you're talking about things like marketplace competitiveness, discount and payment terms offered, flexibility, estimated timelines, and accuracy. The reality is it makes more sense to focus on cost as opposed to just focusing on time, because cost is more inclusive. Cost reduction target is a good place to start. So the idea is to look at the historical cost baseline of a given good or service. What did it used to cost? And then compare it to what it currently goes for, or rather the current cost, and then see the impact. Okay, what's the current impact? For instance, the baseline is $100 and the new cost is $95. Now that could mean many things, but the obvious one is that because of that difference, 95 and 100, then you are saving $5 or you're saving 5%. So that could be what that means if you compare the history and the current cost impact. Total cost of ownership will give you a more comprehensive metrics. Okay, so total cost of ownership is something that you want to look at. Total cost of ownership refers to an estimate used to help buyers to determine the cost, both direct and indirect, of a product or service. Look, direct costs, okay, these are pretty much the costs that you straight away see when you're dealing with something. Let's say if you're producing, whatever it is that you're producing, right? So if you're producing like tables, then you have the direct costs that have to do with direct raw materials, direct labor, direct expenses, right? And then there are indirect costs that are still associated with the entire thing. Like, say, the people who are going to do the sales. Okay. Now, the sales activity has nothing to do with the actual production of the table, but that cost is still part of the entire process. So, when you're talking about, like in terms of production, you look at that. If it is something to do with purchase, then there is the price of buying that table, right? But then you bring it to your factory. There is the cost of transportation. And now it's there. You still have maintenance costs. You still have the room that's going to be stored in. We have storage costs. I mean, the point is, when talking about cost, there is direct cost, there is indirect cost. There are many ways to classify cost. Anyway, so look at this example. All right, so in this case, we are looking at an example of cost measure. And let's say this is the matrix, okay? So let's say, this is the first one. So the area, the key performance area, what exactly are we looking at? Cost or price, right? So what's the KPI? KPI in this case, the KPI to a contract, okay? Or the KPI to industry benchmark. So, that's what you're looking at. And what exactly are we going to measure? So in terms of the contract, you're going to measure the amount of rejected invoice as a consequence of incorrect pricing. So that will tell you something about, the suppliers in this case. And the performance target, all goods or service are invoiced at contracted rate or less. So this is the target, okay? And so if this doesn't match with that, so we look at the number of defective or rather invoices that were not properly done as opposed to what you wanted, and then what's the status here? Is it something that is, you put your status there. Like, is there improvement? Is everything okay? Do we need... Now, in terms of industry to benchmark, okay, so periodic industry benchmark of all pricing units. So what has been happening, okay, and what's the target? So the price you're willing to pay. So price paid is at industry or market benchmark, which should be plus or minus 2%. So we are saying, okay, let's assume the thing is 20. Okay, currently 20. What was it in the past? Does this 20 mean it has gone up in terms of price, or has it gone down? And if it has gone up or down, we are only willing to pay at a plus or minus, say, 2%. So that is pretty much the idea here. So that's an example, okay? That is actually the first example when you're talking about the cost, in terms of, as a metrics to monitor contract performance. Another example here would be, so example 2, we have critical success factors and KPI of a service contract. Now, we're not talking about goods in this case, we're talking about service contracts. Service contracts are a bit difficult to, but anyway. So the critical success factor in this case will be the cost of service delivery must remain within the budget. Of course, the assumption is that you know your budget, right? So what exactly is the KPI here? The contractor is working effectively with the employer to maintain cost at an acceptable level. And the levels are determined by whatever it is that we are at the budget. So what exactly are we going to measure to know whether we've achieved this KPI or not? We're going to measure cost versus budget reports. So what exactly did it cost us as opposed to whatever it is that you had projected? Cost variation, how's the change? Okay. Measurement of innovation and continuous improvement proposals, like in a situation where the contractor is willing to come up with say ways to improve on the cost. Okay, so we look at something like that one. Or us guys, as the clients, are we also allowed to suggest ways in which we can reduce the budget or reduce the cost in this case? So those are examples. Okay, those are examples that will explain cost in terms of a service, a contract that service is supposed to be offered, or even a contract where we're just buying something like a general thing. So to sum this up, if you're developing key performance indicators for suppliers in terms of cost or price, then we need to pay attention to the following. Number 1, basic purchase price or price range. Number 2, price of whole life cost compared with other suppliers or benchmark. Number 3, percentage range of acceptable price or cost variance compared with other suppliers or benchmark. Number 4, target value of percentage cost saving during the period. Number 5, number of cost saving initiatives proposed or implemented during the period. And finally, percentage range of acceptable cost variance from estimated budget costs as a measure of effective cost management. Now that is the thing about cost. Let's talk about the next one. Let's talk about quality. Now, it's obvious that if a supplier doesn't deliver the quality desired, then operations are going to be delayed as a result. And in the long run, resources will be diverted to solve these issues. This is why you really need to be explicit with your suppliers about expectations regarding quality. And, we are saying that, but the assumption here is you even know. Okay, the assumption is that you actually know the quality that you desire, because if you just say, I want good quality, and you really have no idea what good quality in this case means, then you're in trouble. Service quality and SERVQUAL. Now, given the unique nature of services, it can be difficult to assess quality at this level. The SERVQUAL model can be used to help with problems of assessing service quality. Now, the model analyzes the customer's perception, okay? The model analyzes the customer's perception about quality. It seeks to measure the difference between what customers expect a service to be like and how they afterwards perceive the service. So the model seeks to, to understand, or rather to analyze the gap between the expected level of service or the expected service and the actual service as far as the customer is concerned, or as far as the customer is concerned. The model is based on the RATA framework. So RATA in this case stands for reliability, that is the service provider's ability to perform the service dependably and accurately. Assurance, that is the knowledge and courtesy of employees and their ability to inspire trust and confidence. Number 3, tangibles, that is the appearance of physical aspects such as any equipment or facility used to provide the service. In a cleaning industry, for instance, that can be vacuum cleaners, detergents, staff uniform, personnel and communication equipment. Number 3, empathy, that is the identification of customers' needs and expectations and the level of individualized attention given to a customer by the service provider. And finally, responsiveness, that is the service provider's ability and willingness to help customers and to provide prompt and appropriate services. Okay, let's look at an example of a quality KPI. So like a practical example. All right, so in this case, we have a basic KPI. And what exactly are we looking at? We're looking at quality, right? So that's the key performance area What exactly are we measuring? We're trying to ensure that the products meet the standards that we set as green, because you can have like a danger zone where the standards are red, or the assumption is that we have a list of standards that we've developed, and the performance should be at least 95%. So data source, what exactly, how will we know that we are getting these? Well, we look at number of acceptable items delivered, and so now we have the items delivered. So what are we going to do with them? We'll be calculating number of products ordered, and then minus the number of acceptable, and then we divide that by the total products ordered, and then multiply that by 100 to see if we can get that, right? That is the first way to look at it. Now, in a more sophisticated KPI, then you're talking about, of course, you're still measuring quality. So in this case, you're talking about, what are we looking at? Number one, the KPI, is it fit for purpose, and is it compliant to specification? So you see, this is what you're actually more likely to use. So what are we measuring? Goods, number of goods or services received that are subject to additional work. So if we receive goods and we have to do something extra, then that goes to tell you that those goods are not fit for performance, because we need to modify them so that they can, so that we can use them, right? And that will mean they're not fit for performance. And then the target, so goods or service can be consumed with no additional work. So what percentage of that one? So what percent of the time? So if you have like 20% of the time, the goods can be, be just used or service used without additional work. So if that is the case, this percentage here, is what is what determines our target. And so if we meet that, then we put our status, so we don't need to improve on those ones. So the supplier's goods are good, or they need working. So that's the status, right? In terms of compliant, they're talking about number of goods or service that are rejected or unsuitable for consumption. Why? Because, well, they lack something. And what do they lack? We're talking about goods or services. Goods or services are provided to contracted specification a certain percentage of the time. So the higher this percentage, the same as this one, the better. So look, we could ask ourselves, are those goods fit for purpose, or do they meet the compliance specification? If the answer is nope, and the answer is not really, then we are going to have a problem here. So with delivery, you could be talking about product delivery, service delivery, or even on-time logistics. In addition to offering products or service at the right cost and the right quality, a supplier must also deliver at the right time, in the right quantity, and at the right place. So you need to agree with the suppliers on measures regarding performance delivery, and such will include things like percentage of on-time deliveries in full, that is OTIF. Number two, percentage of early deliveries, percentage of late deliveries, percentage of deliveries of order quantity, percentage of deliveries under order quantity, and percentage of deliveries with the correct paperwork. Well, in terms of delivery KPI, here's an example, Here's something that, an example of how you can work that one out. So in this case, you have, so the key performance area, the KPI, what exactly you're going to measure, it's a target and the status, right? So the key performance area, in this case, it's delivery. And the KPIs, you have three: delivery in full, delivery on time, and then secured or no damage, right? So in terms of delivery in full, what are we measuring? Number of orders that are received, incomplete. So if the orders come and they're incomplete, it means they're not in full, right? So you look at the percentage of goods or services provided in terms of the volume or the quantity, whether they are correct or not, and then we note the status. In terms of on-time delivery, number of orders that are received later than expected or later than required. So how late are these people, our suppliers? So you look at the percentage again for that one, and then we make a note of that. And in terms of secured or no damages, number of orders that are received which are defective or are unable to be used. Again, the percentage, okay? And so with that, you start to have an idea of the suppliers that you're working with, and because if they know that, okay, so then that is what you're measuring, then they have to up their game. That is an example of a delivery KPI. But if you're undertaking a project, okay, so if you're undertaking a project as an organization, then the project, the whole idea of KPIs regarding a project usually come down to 3 constraints, okay, the triple constraint, or the so-called iron triangle, which is just a dramatic name for quality, cost, and time. Other factors are increasingly being used now to measure the success of a project. And that would mean that in addition to time performance, cost performance, and quality performance, we have health and safety performance and client satisfaction. Now, safety, okay? Safety is at the top of that, because if you disregard safety in your project, then you're going to land into a lot of legal trouble, among other things. I mean, you see all these buildings that are built and then the safety standards are not taken into account and the entire thing comes down, and that results into a problem, lawsuit, and the contractor could even go bankrupt. And yeah, it's a problem, okay? Project KPIs for health and safety typically include accident reported, lost time as a result of accidents, industrial accident rates covering lost times, external medical treatment, basic first aid and treatment, etc., and accidents avoided. Okay, look, remember the idea behind this entire thing was for you to assess the use of key performance indicators, that is KPIs. And yeah, we did that by first of all learning how to develop the KPIs, and then we went ahead and talked about how to develop rather the metrics, okay, the metrics that you can use to assess the KPIs. And if you have any question, do make sure that you ask. I'm Moses, and I'll see you in the next video.